We often envision the pinnacle of financial success as a machine operating at 100% capacity, where every dollar is deployed and every second is accounted for in the pursuit of maximum yield. It's a seductive idea, the ultimate expression of control and competence in an uncertain world. We're taught from a young age that waste is a failure of character, that any resource not actively working is a missed opportunity for growth. The problem is, this idea of total efficiency isn't as bulletproof as we think. In reality, the closer a system gets to perfect efficiency, the more fragile it becomes. Think of a bridge built with zero wasted material. It's on the verge of collapse because there's no room for error. The same goes for finance. When a portfolio or business is optimized for the highest return possible, it often lacks the structural slack needed to survive any deviation from the expected path. It's a balancing act, where the pursuit of the optimal overlooks the truth that we don't live in a world of perfect information. Instead, we exist in a chaotic environment where the unexpected is the only certainty. Let's imagine Wesley, an investor who has meticulously allocated every single cent of his capital into high-yield, illiquid assets to ensure that no dollar is sitting idle. On paper, Wesley looks like a success. His capital is constantly working. Every resource is being utilized. But here's the problem. Wesley has removed the shock absorbers from his financial life. By reaching for maximum efficiency, he's created a system that is infinitely sensitive to delays. A single late payment, a temporary market freeze, or an unexpected medical bill doesn't just cause a minor inconvenience, it creates a systemic blockage that can lead to total collapse. There's no slack, no buffer, no margin for error. This is what we call hyper-optimization, and it's a silent killer of otherwise robust systems. When a system has 10 to 15% of its resources held in reserve, it has permission to be wrong. This reserve, which the hyper-optimizer sees as a waste or a drag on performance, is actually the very thing that keeps the system stable. Without it, we approach a state where a small change in a single variable causes a massive shift, what we call a phase transition. Wesley, living at 99% efficiency, is always on the edge of such a transition. He's trading long-term survival for a marginal increase in output. He's failing to realize that the energy required to maintain that last 1% of efficiency is creating a huge deficit in resilience. We see this same issue play out on a global scale in systems like just-in-time logistics and lean capital management. For decades, the global economy has shifted toward eliminating all buffers, minimizing inventory, maximizing efficiency, and keeping capital moving as fast as possible. On the surface, this seems like a model of productivity, but underneath, it creates a hidden debt of fragility. There's no redundancy built into the system. When a single link in the chain breaks, the entire system begins to unravel. What was designed to be the pinnacle of economic efficiency becomes a house of cards, where the pursuit of the optimal has increased the likelihood of catastrophic failure. In financial markets, this mindset of optimal efficiency leads investors to prioritize returns at all costs. They're chasing the last sliver of efficiency without realizing that the cost of that final percentage of gain is disproportionately high. The mathematics of it is clear. In any complex system, the probability of everything functioning perfectly over time is essentially zero. The pursuit of perfect efficiency is a statistical guarantee of eventual failure. The math dictates that we need reserves, we need buffers, we need margin. But here's the real kicker. We can't just ignore the concept of good enough. The idea that a small buffer, 10 to 20%, is actually a strategic advantage is a profound shift in how we view risk and reward. By maintaining this reserve, we're not losing efficiency, we're building a more resilient system. It's not about optimizing every dollar, but about making sure that we can withstand shocks without collapsing. The pursuit of that final percentage of efficiency, in fact, follows a nonlinear cost curve. The effort and risk to secure that last increment of efficiency far outweigh the benefits it provides. Imagine running a factory that is constantly operating at full capacity. Every machine is running at 100%. It sounds like efficiency, right? But if one machine breaks down, there's no extra capacity to handle the load. The entire system collapses. Financial systems work the same way. A system that is constantly striving for the perfect return is a system that, by its nature, is fragile. This understanding, that good enough is not a compromise but a sophisticated strategy, is what we need to embrace in finance. By leaving some waste or unused capital, we allow our systems to remain flexible. We allow them to absorb shocks, to handle volatility, and to keep going when the unexpected happens. It's the difference between playing for immediate returns and playing for long-term survival. And in the world of wealth accumulation, survival is the key to success. So, as we think about our portfolios, our investments, and our strategies, let's remember, sometimes the smartest move we can make is to leave a little on the table. It's not waste, it's resilience. It's not inefficiency, it's survival. And that survival? That's what will let the power of compounding do its work over the long run. By embracing the idea of good enough, we start to view wealth differently. Instead of focusing solely on how much we can extract from every moment or every dollar, we start to see value in what we don't need to do. This shift in mindset changes how we handle risk, time, and money. Instead of relentlessly pushing for the maximum return or squeezing out every last drop of efficiency, we start thinking about how we can weather financial storms and adapt to the unexpected. This approach isn't just about taking fewer risks, it's about taking the right kind of risks. By allowing for some inefficiency, some redundancy, we make room for the unpredictable to enter without destroying the system. It's like having a cushion to fall back on during a downturn. That cushion isn't just comfort, it's an active part of a strategy designed to preserve your long-term survival, so that you can play the game of wealth accumulation over decades, not just years. In the financial world, the perfectly optimized investor may appear to be doing well in the short term, but they're building a house of cards. The slightest disruption, a market crash, a sudden need for liquidity, an emergency expense, can topple their entire strategy. They have no buffer. They've overexerted every last piece of their capital. The investor who operates at 80% efficiency, on the other hand, has built a more sustainable structure. They may not achieve the highest returns in a single year, but they have the resilience to continue over a longer period. In life, we constantly optimize everything, our schedules, our spending, our investments, because we believe that efficiency is the key to success. But the truth is, when we remove too much slack, we create fragility. The same applies to how we approach money. A slight misstep, a small mistake, or an unexpected crisis can cause everything to unravel. But with a solid reserve, with margin for error, we become less vulnerable to the unpredictable. We can weather storms, adapt to changes, and continue growing, even when things don't go according to plan. This is where the concept of ergodicity comes into play. In simple terms, ergodicity refers to the idea that over time, the average outcome of a large group is the same as the average outcome for an individual. In financial terms, this means that while the market might return an average of 7% annually, that doesn't mean every investor will experience that same return. One investor might make high-risk bets and lose everything, while another might take a more conservative approach and grow their wealth steadily over time. The individual path matters just as much as the group's average, and a single catastrophic loss can derail an investor's journey, no matter what the average return is for everyone else. This is why it's crucial to think about survivability, not just the likelihood of success. The hyper-optimizer, chasing that final 1% of efficiency, is playing a dangerous game. They're choosing risk over resilience. And while their strategy might work in the short term, it's a ticking time bomb. Eventually, they'll encounter that 1% chance of loss that will erase everything. The investor who chooses a path that's good enough, but includes safeguards, buffers, and reserves, will be the one who survives the long game. In finance, as in life, resilience is the most important asset. It's not about pushing harder or faster to achieve perfection. It's about making sure that when the inevitable disruptions come, you can absorb them and keep moving forward. The beauty of this approach is that it allows you to take the long view. You're not concerned with immediate gains or short-term successes. You're focused on endurance, stability, and long-term growth. In the end, it's not the relentless pursuit of efficiency that creates wealth. It's the ability to navigate through the inevitable ups and downs, to adjust and adapt when things go wrong, and to maintain a steady course over the long run. Wealth isn't just about maximizing returns. It's about ensuring that your financial system remains robust enough to weather any storm. By adopting the mindset of the architect of endurance instead of the optimizer, we acknowledge that life and finance are not predictable. We accept that the unexpected will happen and that the systems we build should account for that. This shift in perspective, while subtle, is the key to long-term financial success. And in a world that constantly demands more, learning to value resilience over perfection may be the most sophisticated financial strategy of all. The ability to survive, to still be playing the game when others have been wiped out, that is the true power of wealth. And by embracing a philosophy of good enough, we can create a financial future that lasts through the inevitable storms and challenges that will come our way. It's not about perfect optimization, it's about building something strong enough to endure no matter what.